Sandeep Tandon joins us, Quant Mutual Funds. Let's take the conversation forward. I mean, Sandeep's got this brilliant ability to predict cycles, talk about valuations, and the way in the dynamic style he manages money. I think he really takes a call which is based on cycles and valuations. So, Sandeep, what is your crystal ball, indicating? Are we in for a tough October and followed by a volatile November? Are we in for a tough volatile patch ahead now?
Because if you recollect, right from July, I've been saying this quarter will be the most volatile phase for the current financial year or current calendar year also. And I thought the data point were showcasing that it should settle down by September, that cycle is getting extended. So volatility cycle is maybe extended, maybe till it can last now till the election phase, maybe post-election, US election I'm talking about is the biggest event is there. So a lot of geopolitical event is also around this election because it's the mother of all election. That's the way it's defined globally. So I think the way we look at the market, yes, it is volatile. But if you get into some of the predictive analytics tool or let's say market implied data, what it say, despite a big crisis in the Middle East, look at the gold price movement, crude price movement. They are not indicating, even the VIX is not any indicating that any perceived risk can be built up from the current level. So none of the data points is endorsing that we need to worry too much about it. And in fact, such opportunity, such volatility can be a buying opportunity in the market. And that's the way I have been talking about that easy phase of bull run is over in India also. And we are in a difficult phase. And a difficult phase has to be very stock specific, sector specific. And you have to play this opportunity, which I think sometimes you do get, let's say today market open 300 points or 400 points. I think it's a selective buying opportunity is there.
What do you make of this entire narrative which is now favoring China over India? How real is that, and do you think that will have implications at least for next 6 to 12 months?
So I think the way I look at, if I look at China versus India, let's talk about scenario. If I look at for, let's say, a few decadal perspective, I think it's India decade. But even if I look at from longer term perspective, I think people have burned their hands badly in China. I think in long term money will not shift. Now question comes from the near term and the medium term perspective. Yes, the market has beaten down significantly. The first time they have showcased that they care actually about the market. So money has shifted and money can shift even in the near term perspective. Whether it can be a long lasting phenomena, I don't think. I think it should ideally peak out in a quarter's time on higher side, maybe this month itself, because it rallied sharply. So by the time you get into it and you get out of the market, it is very difficult to make money after, let's say, ETF, which has moved up 20%, some of the indices moved up 20-30%, stocks have moved up even higher. So I think it will be a challenging phase if somebody says that I will shift money now and make money in China. Smart money has already shifted. But psychological, I have seen that it will be a pressure for India. And then whenever we have seen when China performs, global market don't perform. So it's not only about India. When China outperforms, okay, they work in largely in isolation. Now there is no hard and fast rule, but it's just observation. So some amount, because money do get shifted from one market to other. So I do expect some more money will shift. And that's the reason one has to be very selective.
When you say you think you expect things to remain volatile, what is the definition of volatility? The existing leaders will go up and down, or new set of leaders would come. When every time we are accustomed to hearing the word volatility, market rushes back into FMCG and defensives. What will play out in this leg of volatility?
So when you look at volatility, don't look at an isolation. Don't look at just the vol indices. In fact, vol indices globally have not moved up. They've moved just for a few days and come down. But if I look at the choppiness which I'm referring to, whether you talk about, let's say, currency market, let's come back to the currency market, because in the month of August, 5th August, when we saw yen started appreciating sharply, that was a reversal point for the carry trade. Now, if you really look at today, USD JPY, it's again started rallying, from 140 levels to 147 today. I expect that it has potential to move up even further, which means the carry trades are coming back in the market, which also endorses that liquidity will further increase. So that is a very constructive background, irrespective of whatever noise we have seen on the geopolitical front, but the global liquidity remains very elevated. And that's the reason why global market, global equities are not falling, and including India also, we have not corrected any meaningful manner despite the noise level, which was very high. So one aspect from the currency perspective, the vulnerability aspect is the dollar index, okay? I have been saying that closer to, if not breaking 100 levels also. So perceived risk, if something is there in the market, is in the dollar. If the DXY started strengthening further, this entire narrative, which was based on the metals, has played out very well very recently on the China. That can be affected, or it can be dented at least. So that is the worry, some which we have on the emerging market currency. Now it has not showcased any decisive strength. But if somebody asks me what is the current perceived risk in the market, I think is the DXY rather than anything else.
But Sandeep, you don't put your eggs in the same basket, A, and you don't put them all in one go, right? I mean, history has taught us, and very recently after the election results and other events as well, that our markets also will correct, and the fall could be as steep as even 2.5% on a single day, but that gets very swiftly bought into as well. The question is, what is it that you buy right now, looking at the market and how well discovered it is already?
So our thesis in this volatile phase has been to buy safety, some sort of defensive name. So we have skewed our portfolio towards the consumption name, particularly the FMCG, some amount of pharma, some amount of insurance, some amount of hospitality or healthcare, the hotels, hospitals. These are tourism. These are the names which we think is safety is much more. And obviously, given the background what we are in right now, we have been very vocal that I like to see my portfolio to be more liquid rather than having a large exposure in the illiquid name. And that is the biggest risk which I see in most of the portfolio. The portfolio have rallied a lot, but they will not get any exit in these names, because in market corrects, illiquid stocks don't have any exit. And whatever the changes that the SEBI has proposed on the F&O side, it clearly indicates the activity in the F&O side will come down significantly, and it will increase the impact cost in the market. So as an institutional participant, we are worried about the rising impact cost. And that's the reason I like to play liquid names in the current level, even irrespective of even a marginal fear of underperformance. That is a better strategy rather than getting in the illiquid names and then you get stuck.
That's quite interesting that you say that, Sandeep, because, right now, while of course I understand your distinction between illiquid and liquid names, where you're seeing a chunk of the move is, very selective again. Fewer technology names, auto names from amidst the benchmarks, and of course banks on the other hand, and largely very niche small cap spaces which are seeing the bout of the volumes.
That's correct, because if you really look at, the cycles are getting so compressed, like when we talk about correction can last for a few weeks, it just hardly lasts for a few days, and sometime in a intraday also it reverses. So cycles are getting compressed, and since I talked about the impact cost on the higher side, both buying and selling perspective. So the dent is very meaningful. If you want to exit something, the impact is very large, and if you want to accumulate. So the move is so fast and so swift, it doesn't allow you to actually take any action. And there's a reason why most of the actually portfolios are underperforming, despite the index level is closer to a lifetime high or recently make lifetime high or close to lifetime high.
So, Sandeep, what could be the trigger point when you would say that it's time to perhaps go all in, which is that you're sitting on cash, you move towards defensives? When would you start buying risk or growth or perhaps beta in your portfolio?
So Nikunj, as you know, we are slave of data. We say data is objective is the religion and data is God. None of the data points is endorsing that we should go very aggressively all in. Okay. We have been saying it's a mild risk off period and we are playing. As of now, none of the data points have really changed. I actually expected by end of September, it should settle down with the global volatility, but I think the cycle is getting extended. So maybe closer to the end of this month or maybe post US election, I would like to see how situation changes. So I would like to be very watchful. Again, since we are data driven house or analytic firm, we don't say this is my opinion. It can change tomorrow based on the some of the data points which we look at. But as of now, I will play safe. But opportunity like today, whatever space you are bullish, I think one should participate. So neither I am very negative on the market, nor I'm complacent. I'm, yes, mild cautious and playing it from a longer term perspective now.
Really cautious. And in light of this, then, Sandeep, what would be the approach or the outlook when it comes to the kind of FI flows? Because that has been picking up, but given the China stimulus factor, where do we stand as compared to some of the other emerging markets?
So the most important aspect I think we have to watch, since I talked about dollar index, I think how it impacts. So for currency, USD INR as a pair has been reasonably stable. But for if any reason, if DXY spikes, how it impacts the emerging market currency, I think that is something I like to watch very closely. Second important aspect is that like a lot of people have talking about now money will shift to China. Yes, the easy money, or if I have to look at the hedges money, which is called it, they have already started. They are very swift, so they have already moved out up to large extent. But to say that all traditional long accounts will migrate to China immediately doesn't look like. If it's sustained for a longer term perspective, then maybe people like to review their position maybe end of the year or so. I don't think this 20-30% moves which is happening in the market will change their mindset from China, which has been underperformer, and people fundamentally have taken a negative call on that. So that background, the impact on the India will be a short-term phenomena. It's not a long-term phenomena. So maybe a month, maybe a quarter. Okay. I'm more in the camp that maybe in month itself, okay, this should settle down. And if DXY changes, this entire thesis of China will be on the back burner.
All right, Sandeep, appreciate your time. I know you accommodated a late minute interview request, so really appreciate that, and thank you for joining us.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.